Greetings, everyone. I'm your guide to the world of finance and investing. As we navigate this vast ocean, we stumble upon two significant vessels: index funds and individual stocks. Index funds are like giant cruise ships, carrying a diverse portfolio of stocks, while individual stocks can be likened to speedboats, swift but prone to market turbulence. Our journey today explores why the cruise ship, the index fund, might just be your better bet. So, are you ready to dive into the world of index funds? Index funds come with numerous benefits that make them an attractive investment option. Let's delve into some of these advantages. First up, we have diversification. Index funds provide instant exposure to a broad spectrum of companies. Think of it as putting your eggs in several baskets. If one basket topples, you've still got eggs safe and sound in the others. Now apply this analogy to your investment. If one company in your index fund underperforms, it's likely to be balanced out by others that are doing well. Next, we find that index funds typically have a lower risk profile. This is directly linked to diversification. With your investment spread across numerous companies, you're less affected by the volatility of a single stock. It's like a smooth sailing ship amidst fluctuating waves. The ship represents your investment in an index fund, and the waves, the volatile stock market. Moving on, let's talk about fees. Index funds generally have lower management fees compared to actively managed funds. This is because index funds simply aim to mimic the performance of a particular index, reducing the need for active management and thus the associated costs. It's like paying less for a self-driving car as opposed to a chauffeur-driven one. Lastly, we have the advantage of passive management. Index funds are passively managed, which means they're not subject to the whims and biases of a human portfolio manager. It's like having a robot chef who follows the recipe to the letter, ensuring consistency and eliminating the risk of human error or emotional decisions. As you can see, index funds are a compelling choice for many investors. They offer a diversified, lower-risk investment with lower fees and the consistency of passive management. It's pretty much like getting a deluxe pizza with all your favorite toppings, but without the hefty price tag. Now, who wouldn't want a slice of that pie? While individual stocks can offer high returns, they also come with their own set of challenges. One of these is increased risk. Individual stocks are more susceptible to company-specific risks and market volatility. If a company underperforms or faces a scandal, the stock's value can plummet, causing a significant loss to the investor. The second challenge is the lack of diversification. If you're only invested in a handful of stocks, you're putting all your eggs in a few baskets. This is risky, as the performance of these few companies will greatly impact your portfolio's overall performance. Diversification is a key strategy in risk management, spreading your investments across a wide range of assets to reduce the risk of significant losses. The third drawback is the time and effort required. Selecting individual stocks to invest in isn't a task to be taken lightly. It demands extensive research and constant monitoring of the market. Understanding a company's financial health, industry position, and future prospects requires a deep dive into complex financial reports and market analysis. It's a time-consuming process that requires both expertise and commitment. Finally, investing in individual stocks can be an emotional roller coaster. Seeing the value of your investments fluctuate dramatically can lead to stress and anxiety. This emotional pressure can lead to impulsive decisions like selling stocks at a loss out of fear during a market downturn or buying into a hype stock without proper research. These factors combined make individual stocks a high-risk, high-reward game. While the potential for significant gains can be enticing, it's essential to consider the potential losses and the time and emotional investment required. Investing in individual stocks brings its own set of challenges, which can make it a less attractive option for many investors. It's not just about the potential for high returns, but also about the level of risk you're comfortable taking, the time you're willing to invest, and your ability to manage your emotions during market fluctuations. Now let's compare the long-term performance of index funds and individual stocks. When we look at the historical performance, index funds tend to outshine individual stocks. This isn't a mere coincidence, but a product of their inherent design. Index funds are built to mimic the performance of a broad market index. So when the market does well, index funds do too. Over the long haul, this approach has proven to be quite lucrative. There's a fascinating study by S&P Dow Jones Indices that found that over a 10-year period, more than 8 out of 10 actively managed funds underperformed their respective benchmarks. In other words, the vast majority of funds that were actively trying to beat the market, well, they didn't. On the flip side, index funds with their passive management style consistently matched their respective benchmarks. They didn't need to beat the market because they were the market. This is where we see the power of index funds. But why is it that index funds tend to perform better over the long term? The answer lies in the concept of market efficiency. This theory suggests that at any given time, prices fully reflect all available information. So, it's incredibly hard, if not impossible, for anyone to consistently outperform the market. Index funds capitalize on this market efficiency. They don't try to beat the market, they simply aim to match it. And guess what? This approach works. By just going with the flow of the market, index funds avoid the pitfalls of trying to time the market or pick the right stocks. Pitfalls that often trip up individual investors and actively managed funds alike. In conclusion, when you factor in the lower risk, lower fees, and the benefits of diversification, it's no wonder that index funds have become a favorite among long-term investors. They offer a simple, effective way to grow wealth over time without the need for constant monitoring or adjustment. The data speaks for itself. Index funds have consistently outperformed individual stocks over the long term. One of the main advantages of index funds is their simplicity and accessibility. Let's take a moment to appreciate the ease that index funds bring to the table. Investing can often seem like a complex maze, with a multitude of options that can be overwhelming. But index funds, with their straightforward approach, cut through the noise. You don't need a degree in finance or a crystal ball to predict market trends. With index funds, you're essentially buying a small piece of the entire market. This approach opens up the world of investing to a much wider range of people. Whether you're a seasoned investor or just starting out, index funds offer a straightforward and effective way to grow your wealth. But it's not just about simplicity. It's also about accessibility. Index funds have made investing a possibility for everyone, regardless of their income level or financial knowledge. You can start investing with a relatively small amount and increase your contributions as your financial situation improves. And here's the icing on the cake. Setting up automatic contributions to index funds couldn't be easier. It's like setting up a regular payment for your Netflix subscription. With a few clicks, you can set up a plan to regularly invest a fixed amount into an index fund. This allows you to take advantage of dollar-cost averaging, a strategy that can help smooth out the highs and lows of market fluctuations. With index funds, investing is made simple and accessible to everyone. To sum up, let's recap the main points we've covered today. Index funds offer diversification, lower risk, and affordable management fees. They're passively managed, reducing the impact of human error. On the flip side, individual stocks pose a higher risk, lack diversification, and require time and expertise to manage. Over the long haul, index funds have historically outperformed individual stocks, and their simplicity makes them accessible to everyone. So consider making index funds a core part of your investment strategy. Remember, when it comes to investing, consistency and diversification are key. Thank you for joining me today. I hope you found this dive into index funds enlightening. For further resources, do check out the video description. Don't forget to like, share, and subscribe for more insightful videos on investing. Until next time, stay financially savvy.